Morgen. I'm afraid my German is not very, very good, so I will stick to English today. So my name is Olivier Chemla. I'm lead analyst in the sovereign risk group. I'm with Moody's. And today, the purpose of this presentation is to take you through our thinking about CBDCs and how they interact with sovereign ratings. Just the agenda for today, some quick points about how we deal with ratings, then the credit implications from Central Bank Digital Currencies. We'll take a deep dive into the digital euro. We are here at the city of the euro, if I may say, and then we'll have some concluding remarks. First things first, what are we talking about when we look at ratings? I'm sure you're all familiar, but just a quick recap. We're talking about forward-looking views, opinions on expected loss for investors. We have a 21-notch scale from AAA, the best quality, to single C. And then we have outlooks, and we communicate in different ways to the market. The typical outlooks are either stable, negative, or positive. We also have some more, I would say, discretionary ones. But I can come back to that. I can come back to that if you have some questions. How does a rating committee work? I think that's one of the key questions we get asked very often. Well, basically, I, as the lead analyst, prepare a recommendation on a country. I present that to a committee, roughly 7 to 9 voting members, and the committee decides, votes on the rating and the outlook. And we have a number of features where we try to look for global consistency. So we will always have someone from another regional team. So I work here in Frankfurt and I'm in the sovereign European team, but we also have some colleagues in other parts of the world. We have also colleagues who rate banks, corporates, and then they can also come along. And the way we, as I said, the way we operate is this mix of quantitative and qualitative analysis, and we gather every 6 months. So roughly twice a year, we'll have a rating committee on each of the sovereigns that we rate. Just before I get into CBDCs, I really want to stress how we work and the methodology behind our work, because this will have a very big importance for what we will be discussing about CBDCs. We look at 4 rating factors. We look at economic strength, we look at institutional strength, we look at fiscal strength, and we also look at susceptibility to event risk. So when I will discuss the different transmission channels, I will come back to this. Maybe perhaps a very brief introduction to each of the factors. Economic strength, it's about basically the size of the economy, its ability to grow, its diversification, of course, its scale as well. The institutions and governance strength, it's about 2 things: the quality of the institutions, the policy effectiveness, fiscal policy effectiveness, monetary and macroeconomic policy effectiveness. Then fiscal strength is, well, the bread and butter. I'm sure you're all aware about the main ratios, the debt to GDP, the debt to revenues, because it gives us a sense about how a sovereign is able to collect taxes, but also very important, the debt affordability, so the cost of debt vis-a-vis GDP and revenues. Last but not least, we have susceptibility to event risk. And here we have 4 sub-factors. We have political risk, we have government liquidity risk, we have the banking sector risk, and we also have the external vulnerability risk. So just to set the stage as we embark on this discussion about the credit implications from central bank digital currencies. Well, first things first, right? When you think about CBDCs, when you are looking at a very fast-evolving landscape where you have currently 4 live central bank digital currencies. So most central banks are either exploring or even launching pilots, but it's not something that is currently ongoing on a massive scale. And why is this? It's in a way a reflection of the fact that central bank digital currencies are a response from the public authorities to the development in private markets and in technology as well. So here, if we compare CBDCs with cryptos and stablecoins, I'm sure you're all very familiar with this, but of course, a number of key differences in terms of the issuance type, in terms, of course, of the centralization, because as we all know, on crypto, the main and the original aim is really to have this decentralized aspect, whereas in the case of a CBDC, it would, of course, remain centralized. The volatility aspect, and we'll come back to this, is also something extremely important because, of course, we've seen very large swings, right, in some of the markets, especially if we think, for instance, Bitcoin. And so, in a way, stable coins were already kind of a first reaction to this. But of course, stable coins are as stable as the backing that they have. And coincidentally, it happens that the backing is generally fiat currency. So that's an interesting feature. And then on central bank digital currency, of course, the aim would be to have relatively limited volatility. That's for the main differences between CBDC, stablecoins, and cryptos. But now let me talk about the currency as a sovereign attribute, because we, of course, all know about the direct links between a currency and a sovereign. This has been going on for not decades, but many thousand years. And so it's important to recall that when you think about a currency, you're not talking about any type of asset. You're talking about something, and I'm going back to our economics 101 here, but you're talking about something that has three fundamental properties, and sometimes we forget about this: unit of account, medium of exchange, and store of value. And it's really the combination of those three that really make it a currency. Now, in terms of the objectives that most central banks are pursuing, and if you're really interested in the topic, you can find out more, of course, on our website, but also on different platforms. I'm thinking especially about the Bank of International Settlement, because they are coordinating the efforts on CBDCs. Well, the first objective is, of course, provide a cheap and efficient payment system. And here there are some differences between countries and cultural preferences. Some would say digital instead of cash. Others would say digital and cash. I mean, we're in Germany, right? So we all love cash. That's the first thing. The second aspect, maintain or enhance financial inclusion. And the third one is, of course, maintain the role of public money in society. I think this is really key. So let me see if I can move. Yes, the transmission channels. So coming back to the four factors, right? Remember, economic strength, institutional strength, fiscal strength, and susceptibility to event risk. How do these coincide, and how are these affected by CBDCs? Let me start with economic strength. Here we see two main transmission channels. First of all, the reduction of financial transaction costs. We all know about how costly and sometimes painful it can be to execute a payment even within the euro area. And certainly this is something that could be a positive on the payment system, and so eventually on economic growth. Then the enhancement of financial inclusion, and I will come back to this. This will probably be a key aspect in some emerging and developing economies. The second transmission channel is about institutional and governance strength, and here probably the relationship is the other way around. It's about how an existing credibility of a central bank, or lack of, can affect the project. And here we have a fundamental belief. The fundamental belief is that a digital version of a fiat currency will never be better than the original one. So what does this mean? Well, it's quite easy. If you have a weak currency, weak monetary policy credibility, it's not because you're going to launch a digital version that's, just out of the sudden, things will look much, much better. Conversely, if you have strong credentials, if you have a good track record in terms of monetary policy, then of course, then that can be something that can facilitate the adoption of the digital currency. Fiscal strength, of course, is something to bear in mind, because if we have more digital payments, potentially you have stronger ability for the tax authority to increase and collect more revenues. And susceptibility to event risk is about the banking sector risk. I mean, recall we have 4 sub-factors, and one of those is the banking sector risk, because of course it could happen that if you had a disruption to the banking sector, then of course that could be, sorry, I switched. It could represent a disruption to the banking sector. Now, coming back to my point about financial inclusion and payment efficiency, we put out a report 2 years ago about, CBDCs at the global scale, right? And you can see from the 2 charts how things look like right now in terms of, the cost of executing payments, and of course the sheer size of remittances in many countries, especially of course in the developing part of the world. So you can see, for instance, here you have a number of countries: Lebanon, Kyrgyz Republic, Honduras, El Salvador, countries with double digits of remittances to GDP, and that of course represents a very high number in terms of the cost for those countries to process payments. Now, financial inclusion is probably something that is less of a concern in the most advanced economies in the developed world, but of course, as you get into continents with lower access to banking services, then of course that becomes quite important. You can see here in blue the share of population with a bank account, and in black the population without a bank account. So if you have 30, 40, 50% of the population without a bank account, then of course a digital currency which you could access theoretically through your mobile phone could be something that enhances financial inclusion. Now, let me talk about the digital euro. How do we see it in terms of the transmission channels and the impact potentially on the euro area? First of all, a few descriptive statistics. As you know, both in terms of volume and in terms of value, the share of cash is declining and the share of credit cards and digital payments is increasing. Everyone knows that. Although I always like to insist, this is a 20 countries single currency area with very significant inter-country differences. Then in terms of the risks to the banking sector, of course, this is one thing that many central banks have in mind, especially, of course, here in Frankfurt, the ECB. You can see how things stack up right now between our deposits, the commercial banks, and the central banks. And with the CBDC, how the system would change. I think it's quite fair to say that many precautions are being taken, and especially the holding limit, which is, of course, a key aspect in a central bank digital currency. We don't have the precise number, but you can infer from some public speeches from central bank governing council members, we would be between 3,000 to 4,000 euros, and so the holding limit would be relatively low, and so we wouldn't expect a very high disintermediation risk. Now, going back to the transmission channels and how this would affect the different aspects of the economy, the institutions, the fiscal, and the event risk. On the economy, of course, There could be some marginal gains in terms of economic efficiency, but we see them as limited. Same for financial inclusion. We have a relatively high share, a very high share of people with a bank account, so we don't see this as something material that would materially lift economic strength. On institutions and governance strength, we firmly believe that the ECB has strong credentials, and so it would have a positive impact, of course, on the project. And so we don't have doubts about the ability to deliver on the project. But then the question is, of course, how the project will be accepted also by the population. Fiscal strength, tax collection in Europe in general is quite high. Of course, you have some differences, and you have countries where the VAT gap, so meaning the difference between the theoretical VAT intake and the effective one, is relatively big. And so again, if you have more digital payments that can be tracked by the tax authority, that could marginally increase revenues. And the event risk, as I said just now, we don't see a large risk of disintermediation from the CBDC. Let me conclude briefly and see then if you have questions, or we can meet outside. As I said, over 90% of central banks are either researching or launching pilots on CBDCs. And so we have seen to date limited impact on creditworthiness, on sovereign creditworthiness, but this could rapidly change. And we see 4 conditions for success: a robust infrastructure, I think it goes without saying, resilience to cyber risks. The third one is striking the right balance between privacy and accountability. And this is something where I know there is a large, very acute sensitivity from the public. And then the last point is about finding the adequate setup between the central bank and the government, because let's not forget, central banks are by and large independent in their mandates. So with that, I want to thank you very much for your attention.